Why are the Basel Accords important for financial banks? Have you ever wondered how financial banks maintain stability in a world full of uncertainties? The Basel Accords play a vital role in ensuring that banks operate safely and soundly. These accords set internationally agreed upon standards for bank capital adequacy, risk management, and supervisory oversight. They help protect the global banking system and maintain confidence among depositors and investors. The story of the Basel Accords began in the 1970s when international banking faced serious challenges. Currency disturbances and bank failures prompted central banks from major economies to come together. They formed the Basel Committee on Banking Supervision to create a framework aimed at improving banking supervision worldwide. The first Basel Accord, known as Basel I, was introduced in 1988. This accord focused on credit risk and required banks to maintain at least 8% capital relative to their risk-weighted assets. This requirement was a direct response to the international debt crises of the 1980s, aiming to strengthen banks against potential losses. Then came Basel II in 2004, which expanded the rules significantly. This version introduced a more sophisticated approach to risk management. It divided regulation into three pillars: minimum capital requirements, supervisory review, and market discipline through disclosure. Basel II allowed banks to use internal models to assess credit risk, reflecting the growing complexity of global banking. After the financial crisis of 2008, Basel III was developed to address the weaknesses that the crisis revealed. This accord introduced stricter definitions of capital, higher capital and leverage ratios, and new liquidity requirements. For instance, it established the liquidity coverage ratio and the net stable funding ratio. Basel III also expanded risk coverage to include market risk and counterparty credit risk, making banks more resilient to economic shocks. These evolving standards help banks manage risks more effectively and protect depositors. They also promote transparency and cooperation among regulators across different countries. This is especially important in our interconnected financial world. From a historical perspective, the Basel Accords representing a continuous effort by the international community to respond to past banking crises. They adapt regulatory frameworks to the changing financial environment. The lessons learned from earlier financial disruptions have shaped modern banking regulations. This evolution aims to create safer and more stable financial institutions globally. In summary, the Basel Accords are essential for financial banks because they establish standards that ensure the stability and soundness of the banking system. By setting minimum capital requirements and promoting effective risk management, these accords help protect the financial system and build trust among all stakeholders.